What's going on, everyone? Welcome to the Credit Plug channel. So for today, we're going to be doing a live stream now, and this is something that I don't normally do, but I wanted to cover a couple important topics about what's going on currently in the economy as well as in the credit game. And we're just going to be going over some information, and I'm going to be sharing with you sort of the best path forward, just given where we are, right? So first, I just want to start off with giving you guys just some basic information, right? Now, this right here is information from the New York Fed. So the New York Federal Reserve, they publish these reports. So it's the quarterly household in debt and credit, right? So this is for Q1 of 2024. So this was released a couple of weeks ago, back in May. So I just wanted to go over a couple charts in this particular report. Now, I just wanted to sort of frame this right now. What we're seeing right now, there's a tightening in the credit markets, right? So it's getting harder for consumers to get access to credit. Now, just to kind of paint a picture, we saw an acceleration in the number of credit accounts, particularly if you look at this report right here, when we're looking at credit cards, which is the blue axis. So looking at this, it almost coincides. Like if you look at the first quarter of 2020, if you just put a straight line up here and you look at the trajectory in which credit card accounts grew between Q1 of 2020 to current, or even Q1 of 2024, right? So from this chart, it looks like it was right around like 500 million accounts to now Q1 of 2024, close to 600 million credit card accounts. So that's a growth of about 100 million credit cards. Just think about that, right? And I think this is another reason why we're in this current situation where consumer debt is at an all-time high. It's over the trillion mark, right? Another chart I wanted to go over really quickly. Let's just go. Okay, so the percentage of balances 90 plus days delinquent by loan type. So they got credit cards, student loans, mortgages, auto loans, home equity, revolving lines of credit, right? So as you can see, it's interesting that as the amount of credit cards had started to increase, and mind you, it's a little bit of a lag, right? Because we saw an increase in Q1 of 2020, but right around, I would say Q1 of 2022, we started to see a spike in the 90 plus days delinquent on credit cards. And as you can see with credit cards, credit cards had the biggest upswing, when we're looking at sort of the trajectory of these loan or these credit card delinquencies, right? With student loans, you see it's been dropping. Of course, that's due to a lot of the, student loan pausing, right? So we see in 2020, the delinquencies for student loans basically hit the floor, right? Because people weren't making payments. They didn't have to make payments. That kind of makes sense. We actually start to see an upswing in auto loan defaults, but not at that same pace as we're seeing with credit cards. Mortgages actually surprisingly are pretty low, as well as home equity. But when we're looking at just in terms of the mortgages, one thing that is a lot different than, let's say, in, I guess, 07, 08, when we had that, housing collapse. So this shows the credit scores at origination. So what the borrower's credit scores were when they were approved, right? And so when you look at this bottom 10 percentile, you had scores like sub 600, right? Back then. But now, even at that point, it's a lot higher, right? So you have more well-qualified buyers. And when we're looking at, even back then, to even now, it's just clear that people are a lot more qualified as you see this upswing in the bottom 10%, right? The 10 percentile in Q1 of 07. This looks like probably like a 575 versus now this is over 650. So that's a pretty substantial difference. And so I think that explains why you're not seeing that deterioration as much, even though it is starting to tip up. But the most pronounced is going to be with the credit card defaults. And as you can see, this level right here, we haven't seen, since, let's say, about 2011, right? So just keep in mind, this is on the upswing. All right. So a couple other things I wanted to go over. So this was a report by the St. Louis Fed, right? And so this was just entitled The Continuous Rise in U.S. Credit Card Debt Delinquency. And again, this was published May 14th, 2024. And again, this chart right here shows the percentage of people with delinquent credit card debt, and it continues to rise. And this is disaggregated by the richest 10% of zip codes, the poorest 10%, and then just the U.S. Overall. So let me expand this so you could kind of see the full picture, right? So in this light yellow line, right? So the richest 10 zip codes. Now, as you can see, all of these trend lines kind of follow the same pattern, right? They all sort of started to take that upswing. It looks like probably about, I can't see 100%, but it looks like 2021 and 2022. That's when, for all, zip codes, it started to take that upswing, even in the richest zip codes, right? But especially when we're looking at this gray line in the poorest 10 zip codes, right? You have default rates that are above 15%. In the wealthier areas, or zip codes rather, it's around 5%, right? So doesn't matter, rich, poor, everyone's somewhat being affected by this, as you can see, based on how these trend lines work. So it's not just something that's completely relegated to low income. We're seeing this just across the nation, right? And then another interesting thing. So again, this is the percentage of credit card debt that is delinquent and continues to rise. We're seeing the same trend lines now. Right down here, I just wanted to read this real quick. So it says, what's behind this trend of rising credit card delinquency? One explanation is that we're returning to historically more normal levels following extraordinary low numbers during the COVID-19 pandemic, which was caused by temporary assistance programs. However, present levels of credit card delinquencies are greater than pre-pandemic levels, suggesting that a trend which began prior to the pandemic has accelerated, right? And so, again, more evidence showing kind of what's going on. I also wanted to show this as well, just to give you a sense of, what the household debt levels look like, right? So this chart right here shows household debt and credit developments as of Q1 of 2024. And it has the different categories of household debt, including mortgage debt, home equity lines, student debt, auto debt, credit card debt. Now, as you can see, for most of these categories, except for student loans, we see an increase, and these numbers are represented in the billions. So with mortgage debt increased $398 billion. When we're looking at credit card debt increased $129 billion. And so the total amount over $1.1 trillion just in credit card debt, right? And then just looking at these different categories, right? Credit card debt is in, let's say, obviously you have mortgage debt, which is number one. But again, people have equity usually in their homes. But the rest of these, when we're looking at auto debt, when we're looking at credit card debt, that's just bad debt overall in most cases, right? Now, looking at the serious delinquencies, right? 90 days or more, and comparing Q1 of 2023 versus Q1 of 2024, again, with the exception of student loan debt, all of these categories have increased, even with mortgage debt, right? So mortgage debt, home equity lines, student debt actually decreased in terms of the percentage of delinquencies, 90 days plus or more. And then when we're looking at auto debt, that's also increased. But the biggest jump, again, is going to be with credit card debt, right? So in Q1 of 2023, 4.57%, Q1 of 2024, 6.86%, right? So again, overall, debt levels or delinquencies are increasing across all the different categories of household debt, right? So this is not a good sign of what's currently going on. Now, this graphic right here is pretty interesting. So this was a report, or the data for this report was published by Wallet Hub, right? So this shows ranking the states by credit card delinquency rates. Now, again, it has it broken out in percentages, but when we're looking at the different states on the map, right? So as you can see in yellow, you're going to see much of this in the southwest, or I'm sorry, southeast part of the United States. So Texas, 28.5%, Oklahoma, 28%. You have states like Louisiana, 32%, Mississippi, 39%, Alabama, 31%, South Carolina, 27%, Georgia, 23%, right? So we're having high credit card delinquency rates in these particular states. But again, when we're looking across the United States, I mean, these are all in the double digit figures, right? So overall, not a good situation. Let's see, what else do we have here? Oh, okay. So I wanted to share this as well. So as a lot of you guys probably know, I talk about this from time to time. So PayNet basically has one of the largest databases of commercial leases that includes equipment loans, lines of credit, term loans, right? So they have what's called the Small Business Delinquency Index, SBDI, and they also have the Small Business Default Index, SBDFI, right? So this right here just kind of shows the 31 to 90 day index. And this is going to be the Business Delinquency Index, right, for the US. And this has it broken out, starting in 2006. So as a lot of you guys know, that's when we had the first Great Recession, and we had delinquency rates that, went on this huge upswing. And then, it declined, and then I would say between like 2012 up into about, 2019, 2020. I'm not going to say it was flat, but it was kind of flat. Like, it didn't spike. Then we see in 2020, it did spike, had the stimulus, a lot of the PPP, EIDL, it dropped back down. But again, as I've been saying, around the second quarter of 2022, we're starting to see delinquencies, and this is for businesses, increase, right? So as of May 2024, we're at about 1.71%, right? And so if we took a line and just drew that all the way across, the last time we were at the delinquency rate this high was late, or let's say Q3 of 2011. So nearly, almost 13 years ago, excluding what happened during, the pandemic or whatever, but we haven't seen these rates. I mean, these delinquency index at this high since about 13 years, like, again, excluding what happened during COVID. And as you can see, it's on the upward trend, right? So it's not improving. And mind you, keep in mind, when it was at, let's say 1.7-ish, it was on the decline, right? So it was actually coming down. Now that we're at 1.7, it's actually trending up, which leads you to think, okay, where is this actually going to head towards, right? Because it's just continuing to increase. Rates are being held steady currently. I think the Wall Street prime rate right now is about 8.5%. So again, we haven't seen rate cuts, and this is just another sign of what's going on. So I just wanted to sort of share this information with you guys to give you a sense of what's going on. So this is another report that was published by the Federal Reserve Bank of New York. And they have a division, Liberty Street Economics. So again, this was a report published May 14th, 2024. Delinquency is increasingly in the cards for maxed out borrowers, right? So one thing I wanted to just highlight. So it says right here, let me see if I can zoom in. So the nationwide aggregate credit card utilization utilization rate, that is the share of the aggregate credit limit that is being used, was about 23% last quarter, right? On par with previous quarters. However, the utilization rate of individuals differ widely. 52% of borrowers were using less than 20% of their available credit limit in the first quarter, while 18% of borrowers were using at least 90% of their available credit. 19% were between 20 and 60% utilization, and 11% were between 60 and 90%. So let's just think about that for a second, right? So, okay, 50. So let's say about half of credit card borrowers were using less than 20%. In my opinion, 20% is still kind of high, right? But that's neither here nor there. So 18% were using at least 90%. So 18% are pretty much maxed out, but then another 19% were between 20 and 60%, and then 11% between 60 and 90%. So let's say even if you're using 60%, that's, in my opinion, that's pretty much maxed out. So when you think about that, if we add this 11% that's between 60 and 90, and the 18% that's between that's over 90, that's about what, 29, almost 30% or have a utilization over 60%. Now, if your utilization is over 60%, you're probably not getting approved for, any additional type of credit, right? So again, not a good sign. So again, so this right here is a chart that shows maxed out borrowers and their increasing utilization, right? So this blue line right here just shows from 2015 through 2024, right? So borrower utilization. And then as you can see, this 90 to 100%, it's spiking up, right? So the percentage of balances transitioning into delinquency are increasing for the group that is 90 to 100%. And that makes sense because it's like you only have a little bit of credit left available. And if you were probably able to pay it down, you wouldn't have 90% or higher utilization. So it's, people are pretty much maxed out and don't have the money to pay their utilization down. So again, a lot of this information is somewhat disturbing, right? Currently what's going on. So I just wanted to share this just as a pretext of what I'm going to go into in terms of how to transition when it comes to acquiring credit, whether that's personal or business. Now, I know a lot of people have these different, philosophies on credit. Some people believe you shouldn't be using credit. Some people think that, it's okay. Now, my personal opinion is if you already have a certain level of financial discipline, it doesn't matter if you use credit or not. But if you don't have the financial discipline and you don't have the financial means to repay, then I think you probably should be bootstrapping things because it's only going to put you in a worse off position. Now, and again, there's a difference between good leverage and bad leverage. There's a difference between business credit and personal credit. My opinion is that with personal credit, you only want to use what's necessary for your personal expenditures. And then if you can, pay it off in full every single month to avoid having to pay any interest, right? Now, me personally, when it comes to my personal credit, I think I probably use maybe 2, maybe 3 personal credit cards for groceries and so forth. But again, those are paid in full every single month. And for the most part, never really use personal credit for that matter. Leave that. And then for business credit, that's really what I transact with a lot, right? And it's just a different sort of way that you use it, right? Business credit, you're using it to grow and scale a business and transact with a business. Things that are actually going to make you money. Whereas with personal credit, I don't really see any benefit of utilizing a lot of personal credit cards, right? I think personal credit, you should just leave it pristine and don't really, use too much of it if you don't have to, right? And I know there's this whole movement about, never use a credit card, just use a debit card. I do think there are some practical use cases of having access to credit. I'm not going to get into that for the purpose of this live stream, but I'm a strong proponent of responsible credit, whether that's personal or business. If you're using credit to, let's say, bootstrap a business that is unproven, I don't think that's a good idea. I think when it comes to business credit, the best time to use business credit is when you already have a proof of concept. If you don't have a proof of concept, I feel like you should use your own money or risk your own money to prove the concept before you start to use business credit. Because if you're borrowing money on an unproven business model, that's just only going to leave you in a worse position if it doesn't work out. Now, there's one thing, for example, and this is what a lot of my clients will do. For example, they might take out a loan to acquire a business or open up, let's say, a franchise, right? Either way, these are proven concepts. So what usually will happen is they have more money in their bank account than what they're actually requesting. Now, a lot of people might ask, like, why would you borrow money if you have the money to actually fully finance a project or a business or a venture? And the reason why is because if the business is able to service the debt by itself, a lot of business owners just want that peace of mind of having their money in their account, whether that's in a CD account earning 5% or in a money market account earning 4%, right? It just gives them more peace of mind. And so if the business is able to service a debt, then they don't mind taking out loans to, get that business off the ground or, accelerate that business, right? Because the business is able to turn a profit as well as cover the debt service. So it makes sense, right? And the reason why they have the money set aside is because, let's say things go belly up, they could just use their own funds to then, repay all the debt and, wipe their hands clean, right? But there is somewhat of a peace of mind, let's say, having a certain amount of liquidity just available at all times from a business standpoint. Now, I don't think you should just, let's say, go all in with 100% of your funds initially, maybe a certain portion of your funds, right? Have a little bit of skin in the game, but there is risk to just putting all of your money into an investment, right? Especially like, starting a business, right? Because there is a certain degree of uncertainty, right? You still have to execute, and who knows? You never know what could happen, right? So I think there are some use cases of when to use debt, but when not to use debt. I'm a stronger proponent of using it to accelerate a business with a proven business model, right? Versus using 100% leverage to start a business or prove a concept. I think that spells disaster. And then just getting into it on the personal side, I think if you don't have the financial discipline or the income to repay, I think that could also put you in a bad situation. Now, with all of this being said, right, we see rising defaults, a lot of pressure on a lot of consumers. The one thing I also wanted to talk about was, how do you navigate going forward in this current climate that we're in, if you want to get credit in the future? And I wanted to let you guys know about some things that I've been noticing just from speaking with different fintech entrepreneurs and CEOs, talking to different bank CEOs, what they're doing to sort of, combat what's going on, lowering defaults, right? So what happened, again, as we saw from the chart, and let me actually pull this back up. So just to kind of give you a little bit more context. So what I showed you in, what report was it? Geez, where were we at? Nope. Oh gosh, where's that report? Where was the report? But anyways, from the report that I showed earlier, basically there was an acceleration in the amount of credit cards issued, right? So basically, between 2020 and 2024, there was an increase from about 500 million credit card accounts to about 600 million credit card accounts. So a growth of 100 million credit cards in a 4-year period. And so pretty much a lot of people got more access. And when you think about that, so if there was 500 million and then now there's 600 million, that was a 20% increase in the amount of credit card accounts in a 4-year period. So you had all this accumulation of credit, but then the defaults started to increase as well. So I think that's why we're in this situation now where a lot of that credit that was issued, 2020, 21, 22, 23, a lot of that is going delinquent now. And I think banks are now going to radically change their underwriting procedures. And I'm going to let you guys in on a couple things that I've noticed. Now, several years ago, when I talked about this, a lot of people were skeptical. And for those who remember, I talked about Plaid, right? So for those who don't know what Plaid basically is a data aggregator for bank accounts, so that a lot of institutions use them to get read access into your banking information, right? So this is used by a lot of companies, Venmo, Chime, SoFi, even some of the major, leading banks, right? They're using this for a couple things. For one, identity verification. They also have advanced analytics as well, where they're able to, analyze the trends in your banking information, right? And so this allows institutions to, let's say if they give you a credit limit, but now they see your average daily balances decreasing, over a certain period, they might lower your credit limit, right? And they're also doing income and employment verification, which is going to be the next big wave in terms of underwriting, right? And the reason why is because a lot of banks gave out all this credit and they weren't really checking or verifying your income. So the difference between credit verification and income verification. So credit is a lagging indicator, right? So credit tells past performance, whereas income verification is current, right? So sometimes, for example, your credit could be, let's say you lose your job, right? Your credit is not necessarily going to deteriorate immediately. It might be a couple months or even sometimes a couple years, if you're still in that same situation before your credit starts to deteriorate. Whereas if you lose your job, next week or 2 weeks or a month from now, your banking information, your employment information is going to reflect that you're not bringing in any income. So from the bank's point of view, income verification and banking information is going to be much more granular and much more recent, and in a lot of cases, a little bit more up to date and accurate in terms of your financial condition versus credit. And we know a lot of times credit can be manipulated. You have trade lines, you have authorized users. And another reason why, I've told you guys that authorized users are now becoming almost obsolete, right? At the end of the day, it's not your account, right? And a lot of underwriters are discounting authorized users. But what I really wanted to let you guys know about are some of these new fintechs that banks are now utilizing to change up the underwriting process, right? And this is going to make it harder. This is going to make it much harder. So the point I wanted to hone in this live stream is that going forward, you want to prepare yourself. And I know this is not what people want to hear because, over the past couple of years, people have gotten spoiled with the easy credit, the instant approvals. A lot of people have been sharing with me recent experiences, right? And mind you, I see a lot of the back end data. I partner with a lot of banks, a lot of credit card issuers. I see the conversion rates, and the conversion rates are hitting the floor, right? I've even noticed a difference from, let's say, 2 years ago to now. 2 years ago, 2022, 2021, credit card issuers were giving out credit so easily, instant approvals, high limits, no income verification. All of that is coming to an end. So the purpose of this live stream is to let you guys know what to expect and how to prepare for it, right? And again, a lot of people online, TikTok credit experts, and they're going to make it seem as though you can just go into these banks now with no docs and get all this funding. Now, at one point, maybe that was somewhat true. In general, it's not true, and going forward is definitely not going to be the case. So I wanted to just let you guys know, give you guys a warning, and just in the same way I talked about Plaid a couple years ago, there's a lot of companies, fintech companies now that's going to make it harder if you don't have proper paperwork and documentation. So there's another company called Yodi. This is actually what American Express uses. A lot of people think Amex uses Plaid. Amex uses Yodi, whatever the case is. Pretty much comparable company. They do financial data aggregation. And then you also have a company called Finicity. So for those who don't know, Finicity is pretty much, a comparable company. They're owned by MasterCard. Again, they pretty much allow REIT access. A lot of companies use them. Brex uses them. A handful of companies use them. They're pretty much very similar. Plaid, REIT access to your banking account. They can pull in, let's say, 12 months, 24 months of banking history. So it's not like one of these things where you just add an authorized user and think you're going to trick the bank to think you're more credit worthy than you actually are. This is actually looking way back, 12, 24 months back. So you can't really fake, the income or the data verification when it comes to your banking information. Another company that I talked about recently is in something you need to be aware of are these loan origination platforms. Now, these are great for people who have their information organized. You file your taxes, your paperwork is on point. This is going to allow people to get access to more credit because they've streamlined the process. So on the back end, they have a lot of these APIs with, let's say, the Social Security Administration, the credit reporting agencies, Experian, what I say? I said Social Security Administration, just different data sources they're aggregating together. So instead of the banks doing a lot of this back office data verification, they can do it I'm not going to say instantly, but they can do it in a streamlined manner where you're able to get these lines of credit or business loans or personal loans in a very short time window. Sometimes it's within a matter of minutes. Sometimes it might be within 28 to 48 hours versus if the bank had to do all this verification themselves, it's going to take a little bit longer. So there is opportunity with these loan origination platforms. I've gotten hundreds of thousands of dollars personally just through this numerated loan origination platform I've talked about. Another one, this one is a game changer when it comes to the credit unions. So I've talked about this too. With Clutch. So with Clutch, they work exclusively with credit unions, right? So they help to modernize credit unions, streamline their loan origination process. A lot of them have these instant pre-approvals where all you got to do is put in like your phone number and like your name or address, and they could pre-qualify you. So you see this loop right here where they're just showing you the different credit unions that they work with. So I have a little bit of inside knowledge of with Clutch as well, and they're expanding. So they're probably the premier loan origination system, or at least one of the fastest growing. So they're onboarding these credit unions. And so again, there's a lot of opportunity with it, but let's say if you don't have certain data points, right? Or if you have issues with check systems, or if you have issues with your credit, it's going to be harder because, again, these loan origination systems are pulling all this data from different sources. So you want to be verifiable. You want to check out with these different sources, right? You also have things like Rate Reset, another similar company to with Clutch. They work with credit unions. I've talked about them as well. Another important one is called TaxGuard. So this is going to be more relevant when it comes to business and commercial lending, right? Now, I came across this actually through applying for a business line of credit where one of the lenders actually uses TaxGuard as one of their third-party data vendors where they're checking to see if you have any outstanding or past due federal tax liens. So a lot of times if you haven't paid your taxes or you haven't filed your taxes, sometimes they don't even have to pull your transcripts to figure that out because you have these data aggregators that somehow are able to pull this information. And so banks will use these third parties to verify your information. So if you put on an application, oh, I don't owe any taxes, or, I made X amount of money, they're going to be able to check it electronically and verify it, right? So these are just some of the companies that you want to be mindful of, right? Now, what's going to change the game is this company called Pinwill API. Now, I talked a lot about Plaid over the past couple of years, but this might be the next big, fintech company that's going to change the lending space. Now, I can already confirm that a lot of institutions are already in beta testing. There's a couple that are already live. I believe Vero Bank is currently using them. Now, so the equivalent of Plaid, so Plaid checks bank accounts. Pinwill is checking your recent pay. So they aggregate payroll data from the largest payroll providers, ADP, Gusto, Paychex, all the top payroll companies. So they pretty much have coverage with, the majority of employers throughout the United States. So they are able to aggregate this data. So instead of you having to send in pay stubs, now what they're going to do is have you log into your payroll provider. And so they'll be able to pull that data in. So it's, longer going to be the times where, okay, sending your last 3 pay stubs or sending your bank accounts. Going forward, a lot of banks aren't even going to need to do that. They're going to be able to pull that information automatically. So a lot of the stated docs or stated income, they're not even going to need to do that, because once more institutions get onboarded with these fintech platforms, they're going to be able to verify your information instantly, right? So again, what Pinwill does, as you can see right here, I-9 verification. So they match payroll records to customer profile data, right? So they're verifying your information. And then the opportunity with this is if you have your paperwork in order, if you were, let's say, if you're self-employed, you're running payroll, you're paying yourself, all that information is going to check out electronically. So again, this provides an opportunity, but if you aren't organizing your information, if you aren't documenting your information, it's going to be harder because, again, you're not going to be able to fake it, right? So this is just an example that they're showing right here. So they'll know your employer, who your employer is, the next time you get paid, your average monthly income, your employment status, your annualized estimated income, right? So they're going to have a lot of information. And it goes a little bit further too, because then let's say any savings accounts, brokerage accounts, banking accounts, right? They're going to just have insights, right? And so just to kind of summarize, Pinwill is they market their services to financial institutions, to other fintechs. And again, this is going to be a game changer. I'm telling you guys now, this is going to be a game changer. I've spoken to a couple of banks, a couple of fintech CEOs, where pretty much they're beta testing this. Some have actually made this live. Let me actually show you some of their products. So they have Pinwill Earning Stream, right? Get real-time customer income data. So again, this is designed for financial institutions. So let me just read this. So actionable insights into your customers' earnings. So sourced from payroll and time attendance systems, you could leverage these insights to reduce risks, boost engagement, empower new financial products, and lower acquisition costs, right? So a key point of this, let me zoom in a little bit more, right? So one of the biggest things one of the biggest reasons behind this, and again, the way they're marketing this is as if they're speaking to financial institutions and banks, right? Reduce risk. So how are they reducing risk? By determining in real time what your earnings were, right? So as it says right here, they're going to reduce risks of enabling, reduce risk of enabling earned wage access, cash flow underwriting, and more daily automated updates to payroll and time attendance data. Okay, so this is going to be a game changer again, because it's going to just streamline everything for a lot of the banks. Now, they have what's called earnings to date. So wages the customer has earned so far in the current pay period. Pinwill calculates earnings by using real-time data or real-time shifts in pay stub data provided by their market leading connectivity to 1,600 plus payroll platforms and 40 plus time and attendance platforms, right? So again, they have over 1,600 plus payroll platforms, and these are the largest payroll platforms in the country. So they have coverage. So wherever you might work, they more than likely have your payroll provider incorporated or including in their data aggregation. They also have, future earnings and pay dates, right? So based on scheduled future shifts and current unpaid shifts, they could project future earnings, gross pay minus taxes and contributions for the current pay cycle. Guys, this is a game changer, right? So how do you navigate going forward with a lot of these fintechs that are enabling financial institutions and arming them with more data? So one thing you want to do is just get your paperwork organized, right? Let's just talk from a personal standpoint, right? So personal consumers. So let's say you have a job, great. What you want to just make sure is that your income data is documented, right? So if you're already receiving pay stubs, that's great. I think it's going to actually bode well, because if, let's say, your credit is somewhat deficient, but you have a steady job, which a lot of my clients might be in that position where, they're making good money, they've been working at a job for a certain period of time, but because of one blemish, it's holding them back. So now you can leverage your income as a strong data point for underwriting. Now, let's say you are self-employed, you run your own business. What I would suggest is that you get set up with a payroll provider. If you need a good one to utilize, I recommend ADP. I'll post a link in the description of the video. And just make it a regular habit of documenting your pay, documenting your income, because it's going to help you. One of the things that a lot of self-employed people run into issues is that they're not documenting how much they're actually paying themselves through their business. And I've actually had a situation where, for me, it wasn't an issue, but it actually came as somewhat as a surprise for a business line of credit application. They wanted to see a year-end W-2 because they wanted to differentiate and make sure, okay, how are you actually covering your personal expenditures? Are you just taking money out of the business? And if so, are you documenting how you're taking it, whether it's a distribution or whether it's, you're paying yourself, right? So it comes into play on both sides, personal and business. And then also just being in position, right, is just going to enable you to be able to take advantage of opportunities, whether you're trying to access credit, whether you're trying to purchase a home, whether you're trying to get financing for a new business acquisition, right? So going forward, you want your information. Now, again, one of the major reasons why I think a lot of institutions are migrating towards this proof of income, tax verification, income verification, is because a lot of the fraud that's been going on, right? I've even spoken and had conversations with sponsors where they're basically like, look, we need you to take this video down because we're getting so many fraudulent applications. We have to sort through this. So a lot of institutions are getting hammered with fraudulent applications and high defaults, as I showed you with a lot of the graphics out there. So what happens in times like this, banks are getting hit. So what they're going to do is they're going to try to cut costs. Usually when companies try to cut costs, they'll lay off employees, or they'll look to see where that leakage is occurring. And a lot of the leakage is occurring in, I guess, unqualified or maybe, certain categories of, consumers where they have higher defaults. So to combat that, what they're going to do is improve their underwriting, because if they can improve their underwriting, they can reduce bad debt. And as I showed you with Pinwill API, one of their core components is helping institutions reduce risks, right? Or reduce losses. And so by adding this additional data verification is going to help them and give them more insights to make better lending decisions, right? So again, I think there's two sides to it. There's an opportunity for people who have their paperwork and, are documenting all of their, income. So just to kind of piggyback off of that, right? I spoke to another lender recently, and maybe I could share this with you. Pretty much what's going on in the lending space, right? So, as some of you may or may not know, I do have businesses outside of just content creating and just consulting with people for funding, right? So I was just in discussion with an SBA lender, right? And I'll actually share the information. Now, this was for a 7A loan, right? So the bank is called South State Bank, right? So for those who don't know, South State Bank, so pretty much they're a regional bank, but they offer SBA nationwide. So if anyone's interested in SBA, this is a decent bank to consider, right? But it's interesting. So this bank offers, they have lines of credit, business credit cards, and things like that. But just internally, what I was told from them is that a lot of their traditional, lines of credit. So these are the unsecured loans and lines of credit that they issue themselves. Because of the current economic climate right now, they're actually not issuing any of these right now. Even though on their website, they might say it, currently they're only really doing SBA loans right now on the business side. And again, I had this conversation earlier this week. So right here, in-house banking products have scaled back due to the economy. So banks have already adjusted. Now, the reason why banks want to push more of these SBA loans is because the SBA will guarantee 75%. So one thing you have to remember, most of the times when you hear SBA loan, it's not necessarily the SBA issuing the loan, but it's more or less the bank is issuing the loan and the SBA is coming behind with a guarantee for that loan, right? So not to get too far off topic, I just wanted to share this as an example of why you need to have your paperwork in order to be in position. So they basically, let's say you're trying to acquire a business, right? You need what's called a LOI, right? A letter of intent. So a letter of intent is a legal document between a buyer and seller where you come to a mutual agreement on purchasing, a business, right? So you have an LOI. At that point, you can begin the underwriting process for the SBA 7A. And so pretty much with South State Bank, at least, their minimum loan size for the 7A is $500K. Now, this is not the purchase price. This is the loan amount. The purchase price is actually higher because you have to put towards a certain percentage owner equity injection. All right. And as a matter of fact, I can go over real quick, and I apologize for getting somewhat off topic, but let me see if I can. As a matter of fact, let me just here. I got to pull this up without sharing my home screen. But I just wanted to show you, or just give you some context into what's actually required in terms of your paperwork and documentation for the 7A acquisition loan. So just to go back, here's just a folder of some of the things that you would need. So they have what's called this cash injection eligibility, right? And so, hold on, let me zoom in a little bit more. Now, here's one thing you have to be mindful of, right, with the SBA loan. So the source of the equity injection cannot be borrowed funds from an individual or an institution, right? So a lot of times people think like, oh, I can get this SBA loan, do 100% leverage by, let's say getting some other lines of credit or business credit cards as my 15% down. But it's a little bit deeper than that, right? So you have to document the cash injection. So as it says right here, in bold, it cannot be borrowed funds from an individual or an institution. And so then there's just different, you have to provide evidence of the cash injection pre and post closing, right? And they just have different stipulations on, what counts or what qualifies as equity injection, right? So that's just, one thing to keep in mind. And in terms of the requirements, so the cost of capital for the SBA 7 is actually tied to the Wall Street Journal prime rate, right? So it's going to be the Wall Street Journal prime plus a margin. Right now, and at least with South State, 2.5%. That's pretty decent given what's happening. So this is a little bit unconventional because most of the times you think of term loans as a fixed rate, but with the SBA 7A, Wall Street Journal. So one way to look at it, it's like a variable term loan, which is kind of hard to kind of wrap your head around. And then in terms of what you need to begin the underwriting process. So if you're purchasing it, you're going to need the last 3 of your personal tax returns. And if you are an existing business owner, you also have to provide the business tax returns for any business that you currently own with 50% or more ownership, right? And then from the seller, so this is the business that you're buying, you're going to need 3 years of business tax returns, a year-to-date profit and loss, and a balance sheet, from the seller. You also will be required to put down 15% owner equity injection. So essentially 85% loan to value. But here's the other kicker. You also need 10% of the purchase price post-closing liquidity. So really, when you think about it, you really need 25% down, even though 10% of that is still going to need to show in your bank account. And then 15% is actually going to go to the seller, at closing as part of that, 15% of that 100%, the bank's going to, SBA is going to come behind, guarantee a certain percentage, and then the bank is going to lend out the 85%, right? And the timeline, 90 days, they do have a $2,500 deposit for underwriting once you begin that process, right? So I say all this to say, just to be in position to even consider doing something like this, where you're buying a business, you're going to need 3 years of your own personal tax returns. And if you have any businesses, you're going to need your business tax returns. Aside from that, actually, this doesn't even list everything. So I actually need to update this. But you're also going to need what's called a personal financial statement, right? And of course, they're going to do all their due diligence reports, verify everything, pull your tax transcripts, the whole nine, right? But the whole point I want to make about this going forward is that whether it's personal or business, you need to have your paperwork in order. You need to have your taxes together, right? I also wanted to also hone on this point too. A lot of people, especially so-called businesses, right? They know more about business credit or what their paydex score, right? They have an 80 paydex, but they don't have a profit and loss. Now, let me just go over this real quick because I feel like this is something that needs to be addressed because a lot of so-called business owners don't know what a profit and loss statement is or why it's important. Any real business, they're going to understand what a P&L is and the importance of a P&L, right? So here's just an example of a profit and loss statement. So a profit and loss shows money coming in and money coming out. Now, in this particular example is of a franchise restaurant, right? Now, just to kind of go over this, right? So you have ordinary income and expenses. So you have total income right here is $335,000. Cost of goods sold. So this is going to be all of your, costs to produce. So you have food costs, $82,800. And then the total income minus the total cost of goods sold, that's going to give you your gross profit. And then, so the cost of goods sold is basically the cost of actually producing what you're selling, right? And then you have these other expenses, right? So, franchise fees, insurance, licensing, payroll, right? And so then you have your total expenses all the way down here, 180. So then what you do to get your net ordinary income is that you subtract your total income, you subtract your gross profit from your total expenses, and that gives you your net ordinary income. And then any other income expenses then you would add that in or other income to your net income. And so pretty much, this is what a P&L looks like. One way to kind of think about it is that it just shows money coming in and money going out. And you pretty much need that to know whether or not you're actually, in fact, profitable, right? How else would you kind of understand, your metrics without properly tracking it? So the best thing you can do is get set up with like an accounting software. I like QuickBooks, especially for small businesses, but Xero is also another one. Have that set up. So basically what you would do, instead of tracking everything in an Excel spreadsheet, sign up for QuickBooks. You integrate any expense accounts that you have, any credit cards, any bank accounts. And then what happens is, and it does take some configuration, you have to categorize different vendors, different merchants. And once you categorize them as, let's say, an income or an expense or a payroll expense or office expense or, a franchise expense, once you categorize those different transactions into categories, those categories would then pre-fill to a profit and loss statement or to a balance sheet. So, next time I do a video about, a business funding opportunity, you don't have to complain in the comment section that, oh, this is too much paperwork, or I don't want to produce all that paperwork. All you got to do is log into QuickBooks, download it, right? QuickBooks refreshes like every 24 hours or maybe even every 12 hours, right? So it'll have fresh data in there. So then when the bank asks for a year-to-date profit and loss, or even, looking at, your previous years, all that information is going to be in your accounting system. So you could easily just pull it at the end of every year. I would just do a year-to-date P&L, put it into a folder, and then that streamlines the process when you go about, let's say, you consult me and we come up with a funding strategy on how to stack business lines of credit. You have all of your documents and paperwork together. So it just makes it much easier. And then also the last thing I wanted to make about the paperwork is that when you have your paperwork, your P&L, your balance sheet, your schedule of business debt, your personal financial statement, your tax returns, all of that information, when you're prepared with it, it actually gives a better impression from the banks and the lenders, because they see, okay, you're organized, you're on top of your financial information, and that just leaves a good impression, right? So going forward, you're going to want to have your paperwork set up. Now, if anyone wants to, get a consultation on how to get properly set up, how to properly document and organize your information so that you can take advantage of opportunities, you can get access to hundreds of thousands or millions of dollars in available credit and use that to scale your operations, to purchase a business. I've dropped a link in the description. You could sign up for our Patreon private tier where we map it all out. You get a monthly call directly with me. I'll go over your funding strategy, help you, prepare you to get access to whatever it is that you need in terms of banking. But overall, I think you need to be prepared. Like a lot of this, easy doc, no credit, no paperwork, that's going away with, right? So if you don't organize yourself now, you're just going to be cut off, right? So instead of looking at all these different hacks and, how do I finesse? How do I, get a CPN or get a shelf corp, right? Like just prepare yourself now. It doesn't take that long. I think, if you organize yourself for, 2 years, you'll be in position to be able to take advantage of a lot of the funding opportunities out there. So again, the banks are still going to lend money, but they're going to lend money to those who are qualified. And to just be presentable, you want to have your paperwork organized. So that's all for today's live stream. Let me know your comments and questions. And until next time, take it easy and we'll talk to you soon. Peace.